The stock market is sitting close to record highs, but oil has jumped almost 6% this week. Bond yields are near multi-month highs, and the US consumer just showed real signs of weakness. And geopolitical risk is creeping back into the inflation story. So the question this week is simple. What could actually break this rally? I'm going to walk through the three risks I think matter most, what the market is already telling us about them, and the levels I'm watching heading into next week. Welcome back to the 2% Brief. If you find this useful, hit like, subscribe, and turn on notifications. It genuinely helps the channel reach more people who'd find this useful. So, despite everything swirling around it, the market held up. The S&P 500 finished the week at 7,785, up about 0.4%, and touched a fresh all-time high on Thursday above 7,800. The Nasdaq added around 0.1%. The Dow slipped roughly 0.6%. That split tells you this wasn't a broad, powerful surge. It was narrower and more selective than the headline numbers suggest. So let's look at the three risks. Risk 1, oil. The standout move this week was energy. WTI crude rose from $78.18 to $82.40, up 5.4%. Brent climbed almost 6% to $88.52. That's a big weekly move, and it isn't just an oil story. It's potentially an inflation story. Higher crude feeds into transport, manufacturing, and eventually the prices consumers pay. Now, the main driver is renewed tension around the Strait of Hormuz. Surprise, surprise, not. Shipping traffic remains heavily disrupted, tanker attacks have continued, and the US has raised the possibility of maintaining its naval blockade indefinitely, alongside fresh financial sanctions on Iran. With roughly a fifth of global oil flows normally passing through this narrow waterway, markets are understandably adding a geopolitical risk premium. The level to watch? Brent at $90. Push through that and hold it, and that risk premium gets a lot harder to ignore. And if that happens, it feeds directly into the second risk: interest rates and bond yields. Inflation data was actually encouraging this week. July CPI came in at 0.1% month-on-month, 3.4% year-on-year. Core at 2.5%, right in line. Producer prices were flat, cooler than forecast. On its own, that eases pressure on the Fed. But bonds aren't fully buying the calm. The 10-year Treasury yield is sitting at around 4.7%, near a 19-month high. And it's risen this week, not fallen, largely on worry that surging oil prices could reignite inflation just as the Fed was catching a break. Markets have actually pulled back the odds of a September rate hike from about 55% a week ago to roughly 35% now. But that's still a live possibility, not a settled question. And higher long-term yields make every richly valued stock work harder to justify its price. Now, on Wednesday, we received the minutes from the Fed's last meeting. The market will be passing every line for how divided policymakers are between inflation risk and growth risk. But the Fed may soon have another problem to worry about, because this week, the US consumer started flashing a warning of its own. And that's the third risk, the consumer. US retail sales unexpectedly fell 0.6% in July, the sharpest drop in over a year. Core sales, stripping out autos and gas, also declined. Consumer sentiment from the University of Michigan cratered too, 51 versus a forecast near 54.5. Now, one soft month doesn't mean recession, but layer it on top of everything else: equities near records, oil spiking, yields elevating, and now a consumer showing real cracks. That's not automatically bearish, but it does mean this rally is increasingly leaning on strong earnings and investor confidence to keep carrying it. Next week, we get a direct read on this from the companies themselves. Home Depot, Lowe's, Target and Walmart all report earnings, which will show whether the retail sales softness is actually showing up in company results, or whether it's just background noise. Now, around the globe, Japan was the strongest major market this week. The Nikkei jumped nearly 4.7% to 68,713, riding continued AI capex enthusiasm. Worth watching, Japan is one of the only major central banks still leaning toward tightening, not easing, so don't assume that strength is risk-free. China told a different story. The Hang Seng fell about 2.2% on weak credit demand, and that's a confidence problem more than a rates problem. Cheaper money doesn't help much if households and businesses simply don't want to borrow. And here in the UK, the FTSE 100 fell roughly 1.4%, even as sterling firmed after UK GDP beat expectations, up 0.4% in quarter two and 0.3% in June, both ahead of forecasts. The Bank of England is stuck with a familiar mix: resilient growth with sticky inflation. Metals and crypto, well, gold rose about 0.8% to $4,377, and silver gained close to 2%. Investors still willing to hold defensive assets even with yields this high. Bitcoin went the other way, dropping just over 3% to around $62,878. A reminder, it's still trading like a risk asset right now, not a hedge. So for next week, we have 3 questions. So rather than list every data point on the calendar, boil it down to 3 things. Does Brent push through $90? Do the Fed minutes push yields higher still? And does the consumer data next week, through those retail earnings, confirm more weakness? If all 3 move the wrong way together, this rally faces its real first test since the summer began. If the market keeps absorbing bad news without breaking, that itself is evidence of underlying resilience. And that is essentially the wrap for this week. The rally is intact, but the margin for error is shrinking. Oil, yields, and the consumer are the 3 things I'm watching most closely into next week. Now, if you find this useful, please like the video, subscribe, and share it with someone who follows the markets. Inner Circle members, look for the deeper Sunday evening update on Substack before markets open. And if you haven't joined Substack, either as a free or paid member, please do so. There are links in both the description and comment section below. So my advice to end, apart from look at the videos on screen now if you haven't already seen them, keep watching the reactions, not just the headlines. I look forward to your comments.